Over the years, much has been written about the endowments of prestigious US universities. One endowment in particular, the Yale Endowment, run by David Swensen, has been hailed as a big success. The philosophy behind the so-called Yale Model was summarised in Swensen's book, Pioneering Portfolio Management.
The major characteristics of the Yale Model are that it has a very equity-orientated approach, so it's looking to invest in equity risk or equity-light risks, and it has a tilt towards what we call illiquid assets. So these would be things like hedge funds or private equity, and it has this, at the same time, this belief in a very active style of investing. And David Swensen, in fact, wrote a very good book quite a few years ago now called Pioneering Portfolio Management, where he set out in quite a lot of detail his investment beliefs and how the Yale Endowment went about fulfilling those beliefs in investing the portfolio.
But just because the Yale Model has a good track record, that doesn't mean investors should try to copy it. Indeed, Swensen said as much himself in a later book aimed at ordinary investors called Unconventional Success.
His later book, Unconventional Success, was really trying to tell ordinary investors, don't just pick up the Yale Model and apply that to your investment portfolio, because it's something that requires an awful lot of resources and an awful lot of time in terms of sifting through investment opportunities, looking for the best managers, and involves substantial amounts of risk, and more importantly, costs an awful lot of money, therefore.
As well as setting out what investors shouldn't do, Unconventional Success also recommends what they should do, advice that Swensen has repeated several times since.
If you're an ordinary investor, you're much better off starting from the position of, how do I get equity exposure? So I can do that, for example, through passive funds or through ETFs, and look to try and keep your costs as low as possible. Be very careful about investing in illiquid kinds of assets, where the amount of knowledge that is required to go investing in those areas is very, very substantial.
In recent years, most of the big university endowments have failed to beat the market after costs. Consequently, universities and other institutions are increasingly using low-cost index funds. Unless you have very good reason to believe that you can outperform the likes of David Swensen, you should too.